Hello everybody, welcome to the talk today. It's very great having you. As you know, today we have with us Roman Rericha, and he's a partner of Brandl & Talus, and there he specializes in financial transactions, mergers and acquisitions, business and corporate law. And today he speaks, I think, about a very important topic, which is how to start a company as a team. And very often we know that young startups miss to get professional assistance at the beginning when they start their company, even though this is a very important topic. And we'll start as usually with a short presentation, and I think he will also introduce himself to you. And then you have the chance again, obviously, to ask questions. Use the chance to get as much information as you can. And as usual, we have two ways to do that. One way is to post your question in the chat. But if you would have a short discussion with him, then you can use the raise hand sign. And by using that sign, you actually can ask the question real time. So, Roman, very great having you with us today.
Thank you very much, Stefan. Thank you very much. Hello, everybody. My name is Roman Rericha. I'm working for Brandl & Talus, an Vienna-based law firm. And today's presentation is about startups, legal forms, and how to establish the right startup when you're in a team. Basically, let me briefly introduce ourselves. We are a law firm with approximately 50 employees, specialized in corporate and M&A and capital markets law. We support numerous startup companies from the very first beginning, and some of the examples we recently advised is Bwin over 10 years ago nearly, which is now a multinational company and still relies on our services, which we are quite proud of, and various smaller startups, so Sportradar being a company, the leading company actually, which poses bets, and Win being a social gaming studio, for example. What to expect from today's presentation? Basically, we have two parts. The first part deals with legal forms. We would like to briefly introduce to you, as we assume that most of you already, are experts in the fields of startup companies and the various legal forms, how to establish a startup. We just want to briefly introduce to you the general partnership, meaning the offene Gesellschaft in Austria, the Kommanditgesellschaft, and the limited liability company, and briefly set out the differences between these three companies, which are, basically the legal forms you usually use when you establish your startup. And then, secondly, we want to briefly introduce you to various ways how to regulate the relationship between the shareholders of the company, which is quite important if you form a company as a team and not only as one person. So let us start with legal forms. Maybe it's worthwhile setting out some basic principles. Basically, pursuant to Austrian law, you differ business partnerships and capital companies. Business partnerships, the so-called Personengesellschaften, are characterized by a very low level of organization. The shareholders are fully liable with the private property for any obligations of the company. So you do not have any limitation in liability as shareholder, which is one of the main disadvantages of business partnerships. And the shares are basically not transferable according to applicable law. If you want to make the shares transferable, you basically have to agree on that in the Articles of Association. Usual examples, or the main examples for business partnerships, are the GmbH, die Gesellschaft bürgerlichen Rechts, the general partnership, the offene Gesellschaft, the silent partnership, as well as the Kommanditgesellschaft. Besides the business partnerships, you have the capital companies, the so-called Kapitalgesellschaften, which are characterized by a very high level of organization, meaning that you have a very strict and stringent legal framework within which you have to operate those companies. So you're not as free when doing your business as you are with business partnerships, because the limited liability which you gain with these capital companies is caused or has the backdraft of a tight legal framework. The main advantage of capital companies being in particular the limited liability companies, the Gesellschaft mit beschränkter Haftung, the joint stock company, die Aktiengesellschaft, or the European company. So the main advantage of these types of companies basically are that only the company's assets are available to creditors, meaning that you as a shareholder do not have to threat any recourse of debtors of the company, but the only assets which are available to creditors are the assets of the company. But you have some kind of minimum contribution, so you have to at least pay in 10,000 euros to establish such a company. You can do that also with 5,000 euros, but then remain liable for the remaining 5,000 euros. And the basic legal principle is that the shares are transferable, which is mostly or which is mainly wished by the shareholders. So usually you intend and have an interest as a shareholder that your shares are transferable. So we have prepared a short chart, basically outlining the main principles of a general partnership. As you may see on the left-hand side, you have the general partnership having certain shareholders, in our example 4 different shareholders, and creditors to the general partnerships which provide certain services or sell certain assets to the general partnerships, and gain liability of the general partnership as well of the shareholders. So you have one liability pool, being all the assets available to the general partnership, to the company itself, as well as to the shareholders. So the liability of the shareholders for claims of the companies and for obligations of the companies are personal, unlimited, unrestrictable, direct, primarily, and joint liability, meaning that each single shareholder of a limited partnership, of a general partnership, remains liable for all the different obligations the company undertakes, which is, as you can imagine, not as comfortable for the shareholders. Nevertheless, the general partnership is legally responsible, which means that the general partnership may enter into valid agreements and may sue and may be sued. So there is no, it has their own legal entity, and it is all, and it is legally responsible. How is it represented? Basically, each single shareholder may represent the company, and extraordinary matters, so meaning matters which are outside the ordinary scope of business, require a prior internal approval of all shareholders. Nevertheless, even in case if the extraordinary matters are not pre-approved, each single shareholder may represent the company with respect to such matters and may thereby trigger liability. As regards accounting, I mean, this is one of the main advantages of the general partnership against limited liability companies. Basically, you do have to make a cash method of accounting, being an Einnahmen-Ausgabenrechnung, which is easier and less expensive than a double entry booking accounting, which becomes nevertheless mandatory in case the revenues in a specific year exceed 700,000 euros. There are various other thresholds and requirements to be observed as regards the accounting policies. However, this threshold is the most important one, and given that you are all startup companies, we believe that for the time being, so during the startup phase, you usually do not exceed the thresholds set in order to be obliged to undertake a double entry book accounting. The second company we briefly want to present is the Kommanditgesellschaft. The Kommanditgesellschaft is some kind of a mix of a capital company and a general partnership. Basically, you do have two different types of shareholders. You have the general partner, who is unlimited and unrestrictable liable for all of the company's obligations with all of its assets. So you have an unlimited liability comparable to the unlimited liability of a general partnership. And you have limited partners that solely provide financial contributions and whose liability is limited in the amount of the contribution. So whereas the general partner is actually responsible for observing the day-to-day business, the limited partners are basically not responsible for the day-to-day business, but solely undertake to provide a financial contribution, and their liability is limited to the amount of financial contribution. When you then again have third parties which have certain claims against the company, which is the KG, the Kommanditgesellschaft, the liability pool available to such creditors are all the assets of the company as well as the general partner, however excluding the assets of the limited partners. As already briefly outlined, the general partner represents the company, so he is actually in charge of the day-to-day business, whereas extraordinary matters require the internal approval by the limited partners. And then last but not least, the limited liability company, which is the legal form mostly used when you require additional capital outside the scope of friends and family. Basically, whenever you require third-party money to evolve and develop your business, you would be obliged to, most probably obliged to, establish a limited liability companies. Here you have basically various organs, being the shareholders, which are responsible for, certain major decisions. Then you have the GmbH itself, which is the company having an own legal, being an own legal person, and you have managing directors being the natural persons representing the company. And if you exceed certain minimum requirements, or if you wish to establish a supervisory board, you will also have a supervisory board in place. The main advantage of limited liability company is the limited liability, as the name already says. You have a separation privilege between the assets of the company and the assets of the shareholders, meaning that the shareholders are basically not obliged to are not liable for any obligations of the company with their own assets, but only the assets of the company are available to creditors of the company. However, there are some cases, very unusual cases of direct liabilities, so some cases where the creditors may go to the shareholders and require them to settle obligations of the company. This is the case in case the shareholders mix up their assets with the assets of the GmbH. So wherever the separation is not done properly and not done clearly, you might be liable as a shareholder for obligations of the company. The organization, as already briefly outlined, you have the managing directors responsible for the conduct of the business of the company. You have the shareholders meeting, which is competent for certain specific matters referred to the shareholders pursuant to law, or as you may agree, pursuant to the Articles of Association. And you have the supervisory board if you wish to have one, or if you exceed certain thresholds provided for by law, which you will certainly not do as long as you're a startup company. These thresholds depend upon the numbers of employees in the company or the revenues made by the company, and they're quite high. You have mandatory capital raising and capital maintenance rules which you have to observe, meaning that once you've paid in money into the company, for example, as a way of contribution, you may not take it out again except for annual dividends, basically. So you may only take out money from the company in case the annual results show a profit and you're taking out the profit. If you contribute your the initial capital, for example, you're not entitled to take it out. This is quite important because such capital is available to the creditors and shall be available to the creditors of the company, and if you take it out, you basically put the creditors at a worse position which is not foreseen for by law. In such case, you may end up with some kind of direct liability of the shareholders. You have a mandatory double entry booking accounting, which is more expensive, as already said, than the cash method of accounting, and which is somehow burdensome for startup companies, but nevertheless you can make sure that you have a proper reports in place. And you have a minimum corporate taxation, irrespective of whether you have profits or not, minimum corporate tax. And you're subject to corporate taxation, meaning that you basically be taxed twice. On the one hand, on the level of the company with 25%, and then if you distribute dividends to the shareholders, then on shareholders level again with 25%. In deviation to that, with business partnerships, you do not have corporate taxation, but just Einkommensteuer, meaning that all the profits and all the income is solely taxed at the level of the shareholders. Basically, this was the first part of the presentation dealing with the legal forms. If you have any questions, please just write an email or let me know. Otherwise, I would go forward with certain examples of how you should organize your relationship if you establish a company as a team.
Roman, maybe that's actually a good time to jump in and ask you like one or two questions, because I think this, as you say, is like the first very important part, like what is the right legal form to choose. And again, I would like to ask the audience, if you do have any questions, like what legal form to choose and why, don't hesitate to ask them. Just use the chat form or raise your hand. I would have in the meantime a question, a very basic one. And we always hear about those three forms of those three legal forms, right? We hear about OG, about KG, and about GmbH. And so my question is like, what would you suggest? I mean, there are very different legal forms. They have advantages, they have disadvantages. And I think one of the basic questions young teams have is like, what is the legal form to go for? And what is your experience, and what would you basically suggest? Is it always OG? Is it always GmbH? What would you say on that?
I mean, what we see quite often is that in the very beginning, most of the startups or entrepreneurs establish an OG. Yeah, because this has not any minimum capital requirement. As the minimum capital requirement for the limited liability company has been decreased from 35,000 euros to 10,000 euros. We expect also to a decrease in the numbers of establishment of the OG, to be quite open, because the entrance barriers for the limited liability companies have been reduced. However, as soon as the idea develops, and as soon as you feel that your idea, your company will be in a position to grow and to develop and will require further capital, you usually see that most of the startups reorganize from an OGA to a GmbH, which is the more solid legal form, so to say, meaning that you have a very, very strict legal framework, you have a limitation of liability, which is, quite interesting basically for the shareholders, in particular for external shareholders, so for sole or mere capital providers. So what you usually would expect that once the idea develops, and once the business plan business plan is established and requires further investments, you would found a GmbH. Having said this, it's not an issue at all to reorganize an OG and an offene Gesellschaft into a GmbH, which is done quite commonly, basically.
Would your suggestion then be that you say you start out with an OG and then go for a GmbH, or would you rather say, well, why going for an OG if in the case of success you anyway have to reorganize into GmbH?
Yeah, from my personal perspective, I would always establish a GmbH, always assuming that you may afford one, which is basically you have some minimum corporate tax which you don't have at an OG level, being I think 2,000 euros a year, which you have to pay irrespective of whether you make profits or not. Yeah, you have to afford the minimum capital requirement of 10,000 euros, whereby you have to pay in at least 5,000 euros, and you have to spend some money on the double entry booking, because you need a tax advisor basically to help you with the balance sheets. So it's a bit more expensive in the maintenance and GmbH, but nevertheless you get something which is worth the money, as far as I think, being the limited liability. So from my perspective, my clear recommendation would be to establish a GmbH if the young entrepreneurs can afford that.
And one last question from my side about the first part is, and often when I speak to people, they would say, well, maybe I don't do it in Austria, but maybe I start a mini GmbH, a mini GmbH in Germany, or a limited in England. So what is your opinion on that? Would you say always go for a GmbH in Austria if your main business is located in Austria, or would you say, well, there might be situations where it makes more sense to go for a mini GmbH in Germany or a limited in England? What is your opinion on that?
I mean, what we always recommend is to establish a company in the country where you're actually doing business, right? So if your main focus is in Austria, even in internet businesses, yeah, you may have your seat in Austria. All the developers are working in Austria. So although you have basically a global business, you have some center of main interest, so to say. And if that center of main interest is in Austria, we usually recommend to establish an Austrian GmbH. That's because of various reasons, because basically what some kind of supplier or creditor of a company in Austria would expect is doing business with an Austrian GmbH. What we usually see is that contracting parties have not that great trust into UK limiteds, yeah, because what you cannot, what you have to note is if the company has troubles and if the company, is not able to pay its debts, then usually the contracting parties, prefer having an Austrian creditor instead of an UK creditor where they never get their money back, yeah, or where this might be very difficult. In addition, although yet in particular regarding the limited, although the establishment of a limited liability company in UK is quite cheap, you usually have high costs in maintaining the company. So basically, maintaining a PLC or a limited company in UK is much more expensive than maintaining an Austrian GmbH, because you have these company houses, these service providers who build you up a company, but once you require certain services above the ordinary course, for example, a capital increase, yeah, or a reorganization, this gets quite expensive in the UK, yeah. And as regards to German limited liability company Light, the Unternehmergesellschaft, one have to note that this company has its own legal framework, and what we often hear from people having established such an UG in Germany is that it is quite difficult to do business with these UGs, as everybody knows that the capital provided in the company and the capital within the company is quite low. So basically, to cut a long story short, if you intend to have your seat and your primary main center of interest in Austria, we would recommend to establish an Austrian GmbH. If you want to do business in Germany, a German GmbH may do the trick as well. Also, if you want to do business in UK, you should certainly establish an English PLC or limited company.
All right, thank you very much. So we don't have any further questions so far. So I would say that why don't we jump into the second part?
Yeah, that's great. So what you usually have is you usually, if you establish a company as a team, you have the need to regulate the relationship between the various shareholders, which is often done not in a proper way within startup companies, but which could help you to avoid problems at the later stage, right? So what you usually see is restrictions on transferability of shares, being the so-called Vinkulierung, ensuring that if you establish now a company with 3 other shareholders, these 3 other shareholders may not transfer your shares to a third party, their shares to a third party, and thereby bringing you in a position where you have various shareholders within your company you do not agree with. Then what you would usually expect is a right of first refusal, a Vorkaufsrecht, being the right to buy the shares preferred to a third party. So whenever certain shares are to be transferred, the existing shareholders should have the right on a pro rata basis to take over these shares before accepting that a third party is entering into the company. And then you usually have, or you could agree on tag-along and drag-along rights, being Mitverkaufspflichten und Mitverkaufsrechte. Now in detail, I mean restrictions on the transferability of shares, this is quite a common and very important provision which prohibits certain shareholders to transfer the shares without the consent of the other shareholders. So the freedom to transfer shares is restricted. That is quite important, as already said, in order to avoid that such shares might be transferred and you are confronted with a situation where the shareholder structure alters without your consent. prior to the transfer of shares, you need the approval of the company or of a certain shareholder, however you finally draft the restriction on transferability. So if you have one main shareholder, you can also just link the requirement to such main shareholders, or you can say every single shareholder has to agree to a transfer, for example. And thereafter you have a right of first refusal, so in case the transfer is granted, the other shareholders nevertheless should have the right to acquire the shares which is on transfer in a preferred way. So meaning that the existing shareholders should have the right to acquire the shares before it is transferred to a third party. And the terms and conditions under which the existing shareholders have the right to acquire these shares should be the same terms and conditions as the third party are offered. This ensures basically that also the transferor is not treated worse than it would be treated when selling the shares to a third party. So now how does it work graphically? You have the restriction on transferability of shares and the right of first refusal, which is, as already said, quite common. So you have the existing shareholders of a GmbH, and one of those shareholders wants to sell his shares. So first of all, he has to go to the company and ask the company whether or not he is entitled, or whether or not the company approves the proposed transfer. If the company approves such transfer, he has to offer, so the transferor has to offer his shares to the existing shareholders. In our example, assuming that all of the shareholders have 25%, the party who intends to sell its shares would have to offer his 25% to all the existing shareholders in the amount of 1/3 of 25%. And if the existing shareholders decides not to exercise the right of first refusal, only in such case the third party may sell its shares, the former shareholder may sell its shares to the third party buyer. So you have various safety measures ensuring that the existing shareholders may not be, may not find themselves in a situation where they have a new shareholder they don't want to do business with. So it's some kind of protection mechanism for the existing shareholders, which is quite important in order to ensure that existing shareholders are not finding themselves with an uncomfortable situation at a later point in time. And then another some kind of standard example for regulating the relationships of various shareholders is the drag-along right. So again, you have existing shareholders of a GmbH, and now the majority of the shareholders wants to sell the shares, let's say 75 of 100%, intend to sell the shares to a third party. So basically, I mean, if you sell 100% of the company, as a rule of thumb, the valuation you will obtain will be higher than if you just sell 75% of the company. And most of the buyers would most probably be interested in acquiring 100% of the company, but not in acquiring 75% of a company, having some further minority shareholder they have to deal with. So basically what the drag-along right do, it may force a minority shareholder to also sell its shares to a third party in case the majority wants to sell its shares. Thus, it shall ensure that that an minority shareholder acting unreasonable is not entitled to block a transaction where the company is sold at a good price, most probably to a potential buyer. This provision is quite problematic, as you can imagine, and very difficult to agree on, as a minority shareholder may be expropriated. That's actually done by this provision. However, the minority shareholder, of course, obtains or is only obliged to sell its shares at the same terms and conditions as the majority do. So basically it receives the same purchase price, has to grant the same representations as the majority shareholders have to and do obtain. So from that perspective, he is treated equal as the majority shareholders. And then last but not least, I have a very interesting slide for you, which gives an overview about the possible financing of startup companies, where we have the traditional equity financing, which is most probably the only financing source available to most startup companies, because banks and debt capital may only be obtained at a later stage, at a later point in time, not really in the startup stage. So you have equity capital, where you may do capital increases against the provision of certain capital, depending on the valuation of the company. Basically, you do that in the very early stage with friends and family, then with business angels, venture capital funds, or private equity funds, and at a later point in time, you can also do debt financings. And the following chart shows, as I think quite obvious, shows the obvious, that in the startup stage you usually finance your companies through equity investments, whereas in the growth and in the established stage the equity capital reduces and debt capital increases. So having said this, it's very important for startup companies to have equity capital investments, most probably, and therefore they also need to have proper arrangements in place, making sure that the shareholders can, in case of any dispute, resolve any disputes in a proper way. So I'm at the end of my presentation and remain available for any questions you may have. I hope you have enjoyed it and looking forward to answering your questions.
Yes, Roman, thank you very much for this insightful talk.